Good morning, ladies and gentlemen. This is Clueless 8 Trading. Frank, it's Friday morning around 8:40 a.m. and we are witnessing a what I consider to be a mini black swan event. Bond yields across Europe, specifically in Germany, the Bund has dropped down to almost zero. It's at 0.028%. There's obviously a massive fear trade in motion in progress right now, and we are seeing the consequences of that in the global markets. Our own 10-year government bond deals, which I've showcased recently in multiple charts, is currently trading pre-market at 1.658%. Those are historically extreme levels of safety trades. In other words, global capital, especially large money, is rushing into safe havens, specifically the German Bund, which is equivalent to our 10-year government bond. Okay, the bottom line is, let's try to decipher what's going on here. As I mentioned on Wednesday, as we were ramping big time, that taking large profits off the table, putting out some lottos out there would be the only way to go. And pretty much that's the case, because if you're protecting large profits and not rushing in and putting overweight position into a powerful up market like we saw on Wednesday, then obviously you're going to get trapped. Now, saying all that, the what we have to consider right now is if this is the start of a much larger pullback, or whether or not it's something that will be contained on a retracement corrective basis. There is no way of telling, and that's the bottom line. Charts setups at the end of the day yesterday, which I'll be posting on the Twitter feed, can clearly show that from a technical perspective, that the market on a technical basis, if we didn't have this event situation in Europe, would have opened markets higher. But that's not the way it goes, right? That's why technicals don't always give the 100% picture. It's just just the way things are. Okay, so let's take a look. Let's start off with looking at the E-minis, or the the S&P 500 futures, and what they're doing. Futures are down 15 right now, and this is what we're seeing on the daily charts. Let me just zoom in. In fact, before I zoom in, let me just show you that this was the high back on May of. I'm sorry, this was the recent high on July of. These were the highs on last year at around in July. Actually in May we hit those levels. I don't know why it says July 20th here, but on the E-minis I guess it's July 20th. On the S&P 500 it was May 21st, May 20th. So, and this is where we are right now. Okay, so let's take a closer look to see what we can forecast from these points. Here's the massive double bottom, down in the 1800 level. We rose, and I'm going to draw a uptrend line. And this is going to be in real time. There you go. So if you want to be real simplistic about this matter, the retest of the 34 and the 50-day moving average comes into play at around the 2070 level on the E-minis. That's roughly about 2076, 2077 on the S&P 500. So that's still, bit of a drop from where we are right now. That's roughly about 30 points, or 40 points, I should say. That's roughly translates into another 250 to 300 point drop on the Dow, which would bring us down to around the 17,600 level. Okay, we closed at 17,985, barely shy of 18,000 yesterday. So 17,600 would be a tactical reset of this uptrend line from the lows of 1800. So that's really the most simple way of looking at this matter. Now, so here we are, and that's also the confluence of the 50 and the 34-day moving average, which are trending higher but starting to flatten. So that's a bit of a cautionary sign. like to remind everyone that every single one of my previous video casts talked about this turbulence we're going to hit at around the 15th of June. Well, it just happens to be that the 15th of June is the 15th of June is next Wednesday. So give or take a couple of days, here we are, right? So now here's the date calendar. So there you are, 15th of June, and then you have the Fed meeting at around that time, and whether or not they're going to raise rates, we don't know yet. The market's saying they're not, but you never know. Given the sharp drawdown in global markets, highly unlikely that the Fed will raise rates, but who knows? They just might. We never know these things. Monthly options expiration is 17, generally a bullish event. So after the pullbacks, after the sharp drop downs, it's possible that we could have a quick retracement rally higher into the 17th, possibly starting off at around this part of the week. Okay, now let's go into this here. Looking at this, and look at this large red candle off this rising wedge. It just, there's a gap here, and it just fell. So we're slightly below the Darvas box. So at this point, I'm going to zoom in a little bit closer in the next couple of minutes. But at this point, if you're looking for a swing trade, then you should be shooting for buying S&P puts targeting 2070. You can buy them in the money at 2090 or so, wherever we open up, or you can target the 2080 level or 2070 level as SPX puts as a swing going into next week. Now, the problem with the markets are that they never make it easy. We know that. We puts yesterday pretty much just collapsed, and after attempting to go higher, and then when we went long the S&P calls from about $2, they went as high as $5, right? So that's the way it goes. There was almost 200% plus on the money on tactical calls intraday yesterday as the market reversed. So they never make it easy. But looking at the swing thing, this is a pretty large drawdown on the candles. So saying all that, a logical retracement would be at this level right here. Okay, right here. Now, once it hits that, as it did here back on in May, the right after the middle of May, we got a sharp rally that brought us up here, and another retest is likely. Now, let's go ahead and take a look at what's happening over the shorter term, i.e. over the next couple of days or so. So here's a 1 hour chart, and I'm going to show you. Oh, one other thing I want to show you on the internals on the daily. This one drawdown today is bringing us almost down to oversold territory. Remember, when you get down to these levels here, these are hands down buying opportunities. Okay, and you get a sharp reflex corrective rally higher off these deep oversold conditions on the STOs, on the stochastics, simply way of looking at it. And whether they last or not, depends on what happens, but they generally occur within 24 to 48 hours, as we saw here. We hit the lows. We hit the lows at around 2030, and within the next 72 hours, we were up at 2080 almost. So those are big moves. Those are 200 plus points on the Dow, and you could get a very nice bang for your buck on the S&P calls. Now, saying all that, this is not fully oversold yet on the daily. That's why I'm saying that a retest of the 50 and the 34, or a retest of the mid Bollinger at 2080 on the E-minis, that's roughly about 2086 or so on the S&P 500, is likely, because in order for this to get truly oversold, you need to basically get down all the way down here. Let me just get the drawing tool. So you need to get down here. So the green line has to start moving down fast. And if you notice, every time we get there, the green line has to also join the red stow line below the 20 level. Same thing with the RSI. Some people just play the RSI, buy below 20, sell above 80. So the stochastics is simply a derivative of the relative strength index. Okay, and so the same thing happened here. Um, okay, we went there. We had a higher low here, so that was a positive divergence. So we don't know if we're going to get a positive divergence at this point. And if we do get a positive divergence, then you can expect another powerful rally. Whichever the case, we need to get oversold, period, on the daily for swing traders. Let's take a look at the 1 hour charts here. And I'm going to clear the deck. One second. Okay, there you are. All right, so let's take a look from the 2020 level, which is truly the medium-term line in the sand. Below 2020, all hell breaks loose, and draw the uptrend line. We're obviously broken. What's also disturbing is on the long side is the crossover of the 50 and the 34-day moving average right at this point here. Let's draw a consolidation channel, if it is a consolidation channel, and we can try to do that as cleanly as possible. 1 second here. That's the overshoot right there. And the best way I can draw it is like this. So that brings us down to about 2084. Maybe that holds, that is a interim support for the markets for the past couple of weeks. And you can see that clearly on this line. Watch. There you go. Because that was support here. Let me get the drawing tool again. And these are important because anything we're trading in the front side is going to be dependent on what happens here on the back side on the E-minis, right? Just the way it goes. So at this point, this retest is almost inevitable, okay? So one way or the other, doesn't matter if there's a little bit of short covering at the open in the market or not, this retest is inevitable, and that's around the 2080 level. Once it completes this this pattern, it possibly has another bounce up towards the 2100 level to create a right shoulder. People who are familiar with patterns, they should be familiar with this. You have a head, a double head if you want to look at it that way. You have multiple shoulders, okay? Multiple shoulders, and we could hit 2100, and then we could we could pull down and then move up again, and then if we fail, then we're going to break the neckline that's at the 2080 level. So the bottom line is, it's really as simple as this. We are getting down towards 2080 or so on the E-minis, and you got to watch this. If this line breaks, we got to fall real fast, and we're going to hit the next support level here at around 2045 or so. And then we got the 2020 level to deal with. Now, we don't know whether that's going to happen, and that is where flexibility comes in. All right? I'll do my best to do what we need to do, but people who are not active traders should basically just sit out today, because honestly speaking, it's going to be a hectic day and lots of false mini pull-ups and pull-downs. But whichever the case, this is the actual picture of what the market is intending to do. Because the fallout from these bond deals, bond prices shooting higher, bond deals collapsing, safe haven buying, gold rallying, is not something that can just automatically reverse itself within a matter of hours. It takes a bunch of days. So that's it for now. Thank you for listening.